Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button, and don't forget to turn on the bell for updates on all our latest content. What if I told you that a simple $10,000 investment could quietly grow into over $22,000 in just 10 years, without the stress of picking individual stocks, timing the market, or paying high management fees? And what if I told you that by adding just $100 a month to that investment, you could build a six-figure portfolio over time, even if you're starting from scratch? In this video, we're diving deep into the 5 best Fidelity index funds that can help you do exactly that. These aren't just any funds. They're low-cost, highly diversified, and built for long-term growth. We'll explore how you can get exposure to the entire U.S. stock market, international economies, and even bonds for added stability. We'll also show you why Fidelity's zero-expense ratio funds are a game-changer, helping you keep more of your returns by eliminating hidden fees and offering tax efficiency that's perfect for both retirement and taxable brokerage accounts. Whether you're a beginner investor or looking to simplify your portfolio with a hands-off strategy, this breakdown will give you the tools to build wealth steadily, consistently, and with confidence. So stick around, because the path to financial freedom might be simpler than you think. The power of index fund investing. Investing in index funds has become one of the most popular and reliable strategies for building long-term wealth. With low fees, broad market exposure, and the potential for compounding growth, index funds are a favorite among both beginner and experienced investors. Among the many investment platforms available, Fidelity stands out for its wide range of low-cost index funds, offering a solid mix of domestic and international exposure. This article explores what could happen if you invested $10,000 evenly across 5 of the best Fidelity index funds, analyzing historical returns, diversification benefits, risk management, and long-term potential. Why choose Fidelity? Fidelity is one of the most trusted names in the investment world, with decades of experience and a commitment to low-cost, investor-friendly products. What sets Fidelity apart is its line of zero-expense ratio index funds, some of the first of their kind, as well as its comprehensive lineup of traditional index funds that track key market segments. Fidelity offers investors exposure to domestic stocks, international equities, small caps, large caps, and bonds, allowing for a diversified portfolio with just a handful of funds. For our hypothetical $10,000 investment, we'll split the amount evenly into 5 top-performing Fidelity index funds. The 5 best Fidelity index funds. After analyzing performance, fees, diversification, and popularity, the 5 best Fidelity index funds to consider are: 1. Fidelity 500 Index Fund, FXAIX, tracks the S&P 500. 2. Fidelity Total Market Index Fund, FSKAX, covers the entire U.S. stock market. 3. Fidelity Zero Total Market Index Fund, FZROX, a zero-fee fund tracking U.S. stocks. 4. Fidelity Zero International Index Fund, FZILX, a zero-fee fund tracking international markets. 5. Fidelity U.S. Bond Index Fund, FXNAX, provides exposure to U.S. investment-grade bonds. By allocating $2,000 into each fund, we build a well-balanced portfolio with exposure to large-cap U.S. stocks, the total U.S. market, international equities, and bonds, all while keeping fees minimal. 1. Fidelity 500 Index Fund, FXAIX. The Fidelity 500 Index Fund, FXAIX, is Fidelity's flagship large-cap index fund, mirroring the S&P 500 index. This fund includes the 500 largest publicly traded U.S. companies, such as Apple, Microsoft, Amazon, and Google's parent company Alphabet. With an expense ratio of just 0.015%, it is one of the cheapest ways to gain access to the overall performance of the U.S. economy. Historically, the S&P 500 has returned around 10% annually on average. Investing $2,000 in FXAIX 10 years ago would have grown to approximately $5,200 by 2025, assuming a compounded annual growth rate of 10%. While past performance doesn't guarantee future results, the S&P 500 remains a cornerstone for any growth-oriented portfolio. 2. Fidelity Total Market Index Fund, FSKAX. FSKAX takes diversification a step further by including small and mid-cap stocks in addition to large-cap companies. This fund tracks the Dow Jones U.S. Total Stock Market Index, which consists of more than 3,500 companies. FSKAX offers a more comprehensive view of the U.S. economy compared to FXAIX and has a slightly higher risk-reward profile due to its exposure to smaller firms. With a low expense ratio of 0.015%, FSKAX is also cost-effective. Historically, the total market has slightly outperformed the S&P 500 over long periods, especially during bull markets when small-cap stocks rally. Over the past decade, FSKAX has delivered annualized returns close to 10% as well. A $2,000 investment in FSKAX would have grown similarly to FXAIX, potentially yielding about $5,300 over 10 years. 3. Fidelity Zero Total Market Index Fund, FZROX. FZROX is one of Fidelity's revolutionary zero expense ratio funds. It provides exposure to the entire U.S. stock market with no management fees, making it incredibly attractive for long-term investors. Despite being newer, launched in 2018, FZROX closely tracks the performance of other total market index funds like FSKAX. The lack of fees means more of your money stays invested and can grow over time. If FZROX continues to mirror FSKAX's performance, you can expect similar long-term results. While its short-term history is limited, early returns have been promising. Assuming an average 10% annual return, a $2,000 investment could potentially reach $5,200 to $5,400 in 10 years, depending on market conditions. 4. Fidelity Zero International Index Fund, FZILX. For global diversification, FZILX is an excellent option. This fund tracks non-U.S. developed and emerging markets, offering exposure to major economies like Japan, the UK, China, and Germany. International diversification helps reduce risk and capture global growth opportunities, especially when the U.S. market underperforms. FZILX also has no expense ratio, making it a cost-effective way to diversify geographically. Historically, international markets have underperformed U.S. markets in the last decade, with average annual returns of 4 to 6%. Still, over the long run, global markets tend to catch up. If we assume a modest 6% compound annual growth rate, a $2,000 investment in FZILX could grow to about $3,600 in 10 years. In bull cycles for emerging markets or the Eurozone, returns could be significantly higher. 5. Fidelity U.S. Bond Index Fund, FXNAX. To balance the volatility of stocks, adding bonds to the portfolio is essential. FXNAX offers exposure to U.S. investment-grade bonds, including Treasury and corporate debt. With a very low expense ratio of 0.025%, it is a safe, low-cost vehicle for income and stability. Bonds typically return around 3 to 5% annually. While this is lower than stocks, bonds provide protection during market downturns. For instance, when stocks crashed in 2020, bonds held relatively steady, cushioning portfolio losses. If FXNAX returns an average of 4% annually, a $2,000 investment would grow to approximately $2,960 in 10 years, providing a stable, predictable return. Building the $10,000 portfolio, a snapshot. If you invest $10,000 by dividing it evenly across 5 top Fidelity Index funds, you would allocate $2,000 to each. Based on historical average returns, the Fidelity 500 Index Fund, FXAIX, Fidelity Total Market Index Fund, FSKAX, and Fidelity Zero Total Market Index Fund, FZROX, could each deliver an estimated 10% annual return over 10 years, potentially growing to approximately $5,200, $5,300, and $5,400 respectively. The Fidelity Zero International Index Fund, FZILX, with an estimated 6% annual return, may grow to around $3,600, while the Fidelity U.S. Bond Index Fund, FXNAX, with a more conservative 4% annual return, might reach approximately $2,960. Combined, the total value of this diversified portfolio could grow to around $22,460 over a decade, more than doubling your initial investment. This projection assumes a stable market environment, historical performance trends continuing, and no additional contributions or withdrawals. The mix of U.S. stocks, international equities, and bonds ensures a balanced approach that captures growth while managing risk. After 10 years, this diversified index fund portfolio could nearly double, potentially growing to over $22,000. This return assumes a steady market, historical average performances, and no withdrawals or additional contributions. Tax efficiency and fees. Fidelity's index funds stand out not only for their strong performance and low costs, but also for their tax efficiency, an important factor that many investors overlook, especially in taxable brokerage accounts. Index funds are inherently more tax efficient than actively managed funds because they have lower portfolio turnover. This means fewer assets are bought and sold within the fund, which reduces the frequency of taxable events like capital gains distributions. When these distributions occur, investors are required to pay taxes on them, even if they haven't sold any shares themselves. With Fidelity index funds, especially the passively managed ones, this turnover is kept to a minimum, which helps defer taxes and improve after-tax returns. What makes Fidelity's offering even more compelling is its line of zero-expense ratio funds, such as FZROX, Fidelity Zero Total Market Index Fund, and FZILX, Fidelity Zero International Index Fund. These funds not only avoid management fees entirely, but also maintain the same tax-efficient characteristics of other index funds. While a small expense ratio, say 0.1%, might seem negligible in the short term, over a few decades it can translate into thousands of dollars lost to fees. For example, on a $100,000 investment, a 0.10% annual fee amounts to $100 per year, which could otherwise be compounding along with your investments. Eliminating that fee altogether, as Fidelity does with its zero funds, enhances compounding and helps investors retain more of their returns. Furthermore, the structure of Fidelity's index funds allows them to manage capital gains more strategically. By using in-kind redemptions and other tax-aware management techniques, Fidelity can minimize taxable distributions, making them ideal choices for taxable accounts as well as tax-deferred retirement accounts. In essence, these funds allow investors to grow their portfolios more efficiently and maximize long-term gains by reducing unnecessary tax drag. For anyone aiming to build wealth steadily over time, especially outside of retirement accounts, Fidelity's tax-efficient, low-cost index funds are a smart, strategic choice. Rebalancing and reinvestment. To keep the portfolio aligned with your goals, it's wise to rebalance annually, realigning allocations back to their original targets. For instance, if FXAIX outperforms and grows disproportionately, you may want to sell a portion and reinvest into underperforming funds like FXNAX or FZILX. Additionally, reinvesting dividends from these funds can compound growth further, helping your $10,000 work even harder. While a $10,000 investment offers a solid foundation, the true power of index fund investing is unlocked through consistency and time. By making regular monthly contributions, say $100, you're not just increasing your principal, but taking full advantage of dollar-cost averaging and the compounding effect. Over 30 years, assuming an average annual return of 8 to 10%, This steady strategy could grow your portfolio into a sizable nest egg worth between $180,000 and $250,000 or more, depending on market performance. Fidelity's range of low-cost index funds makes this path even more effective by minimizing fees, which can significantly erode long-term gains. Funds like FXAIX, FSKAX, and FZROX capture the long-term growth of U.S. markets, while FZILX and FXNAX provide global and fixed income diversification to reduce volatility. This diversified, disciplined approach allows investors to ride out short-term market swings and benefit from long-term upward trends. Whether you're saving for retirement, a home, or financial independence, a well-constructed index fund portfolio with regular contributions can steadily transform modest beginnings into substantial wealth. It's a smart, stress-free path to financial freedom that rewards patience, discipline, and a long-term mindset. Thank you for watching WealthEchelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.